Hi, my name is Sam Koch and I work at Wilson Asset Management as a Senior Investment Analyst in the small to mid-caps team. I'm here to talk to you about our big call. Our big investment call is that small caps will outperform the broader market. If you go back to late 2021, early 2022, inflation was rising around the world and central banks were rapidly raising rates to try and bring that under control. Ever since then, over the last 3 to 4 years, small caps have underperformed the market. And it makes a lot of sense. Small caps are typically more leveraged to their domestic economy, typically perceived as being slightly riskier investments, so require a more buoyant market to outperform, and they're typically less capitalized as well. However, we would put it that we're firmly in a rate cutting cycle at the moment, and so this sets up small caps to start to outperform. If you go back to August when companies were reporting their FY 2025 results, small caps really started to outperform the broader market. And that was because they had slightly better results and slightly better outlook statements as well. And you saw that with consensus EPS revisions being less bad than feared. If you couple that with a really attractive relative valuation perspective, then the starting point for small caps to outperform is there. We're picking apart the opportunity here into 4 key subsectors. You've got rate cut beneficiaries, technology, mining industrial services, and catalyst-driven ideas. Firstly, on the rate cut beneficiaries, there's probably no better company leveraged to rates falling than Autosports Group. The ticker is ASG. Autosports Group has triple leverage to falling rates. They're Australia's largest luxury car dealership group. They have stakes in BMW, Audi, and Mercedes, and a couple of number of Chinese brands as well. As rates come down, consumers have more disposable income to be buying things like luxury cars. They also have the opportunity to participate in their finance and insurance packages as rates have fallen, and that's actually quite a high margin revenue stream for ASG. And then lastly, as rates have fallen, ASG needs less debt to service that larger inventory balance. And so for every 25 basis point rate reduction, you see a $2 million benefit in earnings for ASG. Secondly, you've got Megaport in the technology bucket. Megaport is a clear beneficiary of the boom in AI spending. They have a number of connections to data centers globally. If anyone's trying to leverage the opportunity that artificial intelligence presents, they're going to be connecting through Megaport. And we see this company outperforming the rest of the technology sector. Thirdly, ServiceStream in the mining and industrial services space has been benefiting as the economy has been picking up as a whole, and that has meant that there's been more work for them to perform. They've recently secured a $1.6 billion pipeline of work with the Department of Defence, and we believe that the company will wrap their arms around it and continue to grow that from here. And lastly, in the catalyst-driven ideas is TUA, Tuas Singapore. TUA is the clear challenger in the local telco market in Singapore. They've been winning share from the incumbents as the number 4 player and have recently raised capital to buy the number 3 player, really growing their market share rapidly. We believe that the market is underestimating the opportunity from extracting synergies post that deal. So that's it. That's our big call, that small caps will outperform the broader market, and the recipe for success is there. You've got valuations that are attractive, you've got firmly in a rate cutting cycle, and the outlook is slightly more positive than expected as well. Thanks for joining. Please feel free to reach out at any point in time. We're always happy to chat ideas and the portfolio as a whole.